A very good afternoon to everyone, and thank you for joining us once again for this exciting webinar with my CPE1. I am Sam, your moderator for today's session. Today's session will be on doing businesses in Canada for US tax advisors. Our expert presenter for today is Afan Khalid. If I talk about Afan, he is an international tax advisor with over 15 years of public accounting experience. Tax planning, structuring, and compliance for Canadian and foreign multinationals. Afan has guided corporations on merger, acquisition, reorganization, and repatriation strategies. He also holds a BBA from the University of Toronto and has completed advanced international tax programs. Before we dive into today's presentation, I want to make sure that everyone can hear me clearly. If you are experiencing any technical difficulties or have any questions during the webinar, please don't hesitate to use the chat or question and answer panel. I'm here to assist you. As a reminder, today's session is worth 1.5 CPE credits, and we will be launching 5 polling questions throughout the presentation. And to earn your credit, you need to answer all of them, so please make sure you participate. You will also receive an evaluation form within the next 24 hours, and we'll love for you to share your responses. Well, that's all from my side, and I'll now hand over things to Afan. The floor is yours. Thank you.
Good afternoon, everyone. Thank you so much for joining the webinar. Today's topic is doing business in Canada. It's a US tax advisor's guide. It's an interesting course, an hour and a half presentation. I'll walk you through some comparative between the US Canada tax and we'll dive into the basics, fundamental of Canadian taxation, especially when it comes to US advisors assisting their clients with expansion into Canada, or if US companies are doing business in Canada, we'll go through the Canadian tax implications. Very quickly, I've been in public practice for over 18 years. My area of expertise is international tax, consulting, planning, tax compliance, at pretty much anything under the tax space for Canada tax. I'm more than happy to guide and assist. The course objectives for today is we'll start with the Canadian income tax overview, and then we'll talk about what are some structures to operate in Canada. And then we'll briefly talk about the tax treaty, US-Canada tax treaty, and what are some of the benefits that US companies can enjoy when they expand their operations into Canada. And then we'll talk about the overview of Canadian sales tax, GST HST, some payroll tax implications. We'll talk about tax waivers and certain type of withholding taxes that applies to US companies providing services in Canada, sending their employees to Canada. And finally, we'll finish our session with brief discussion on tax compliance, record keeping, and ongoing obligations. So the first thing is, some common, some comparison between the U.S. tax and the Canadian tax. It's very high level, just so you know when you're speaking to Canadian, Canadian tax advisors or sending or advising your clients coming into Canada, there are certain terms and terminologies that, of course, are different from U.S. tax, but things you need to know. So in terms of tax authorities in Canada, we have CRA, which is Canada Revenue Agency. That's the one that monitors the filing and all the tax compliance and process all the returns. Whereas in the US, there's IRS along with state tax agencies. In Canada, we don't have too many state tax agencies. Federal tax, or the CRA, it's a federal body, will monitor and take care of most of the tax compliance for federal level and the provincial level. However, there are some nuances where, say, Quebec has their own tax agency, and they will process and register businesses that are operating in Quebec for QST and the federal tax. Similarly, Alberta has their own corporate tax, but for the most part, it's very harmonized. It's CRA, it's a federal body, generally look after all the Canadian tax matters. Tax base, unlike US, if a individual corporation or trust partnership, if you're considered a resident of Canada, then worldwide income of the resident is subject to tax in Canada. Whereas in the US, it's based on citizenship and few other things, but in Canada, it's primarily a residency test. The tax system type, it's self-assessment and progressive rates, which is the same in Canada, no differences there. The key legislation in Canada, it's the Income Tax Act for income tax matters and Excise Tax Act for the GST HST matters. There are some other acts as well, but these are the two um, main categories of income tax act or tax legislation that apply to US companies and individuals coming into Canada. In terms of the filing deadline, in the US, you have April 15th, along with some extensions available, whereas there's no concept of extensions in Canada. For individuals, the deadline is April 30th of the following year, and for corporations, it's 6 months after the year end. In terms of corporate tax rates, the federal in the US, the federal rate is 21%, along with some state rate. Some states have no tax, and some states have their own state tax. In Canada, the federal tax is 15%, and then we have provincial tax. So each province has a different um, corporate tax rate, but approximately the rate is about 25% on average. In Ontario, it's 26.5, but as I said, it's the rate approximately 25, 26% for a US company operating or doing business in Canada. Sales tax, this is GST HST in Canada. At the federal level, the GST is 5% across all provinces. And then for the provincial component is separate. In most cases, the federal and the province rates are harmonized, so we call it harmonized sales tax, and then you'll be paying one type of tax on the sale of goods and services. Say in Ontario, the rate is 13%. In Alberta, in BC, it's just 5%, means the provincial rate is zero, and so on. And then the residency rules, unlike US, in Canada, the taxation is based on residency, which is primarily tied to residential ties and presence test in Canada. In terms of the filings, and what I've tried to do is just to give you the terms and terminologies that we use for certain type of tax returns compared to what is the US equivalent. So it will help you compare and understand the nature of the filings. So uh, Form 1040 is the individual tax filing for a US person, whereas in Canada it's called T1 individual return. Corporations in Canada, we use the term T2 or corporate tax return, whereas in the US it's Form 120 for corporations. For partnerships, the equivalent term used here is T5013, whereas in the US it's 1065. And for employment slips, the term we use is T4, which is most popular. T4, whereas in the US it's W2, it's equivalent. And then RSPs are similar to 401k in the US, TFSA account, a tax-free savings account here in Canada, equivalent to Roth IRA. And IRA And then GST HST, equivalent to state sales tax. I understand there's no federal level VAT in the US, but it's unlike in Canada, we have a federal level 5% plus the provincial rate. And then for notice of assessment, any tax filing submitted like T1, T2, uh, when returns are filed, the government will issue a notice of assessment confirming the processing of the return and showing any um, any amounts owing, interest penalties and whatnot. Whereas in the US, the term is equivalent term is tax transcript or notice of assessment. And then the last one is permanent establishment. This is the term we use across different types of um, taxes for corporations, having permanent establishment at the provincial level or maybe PE in Canada, whereas the equivalent term in the US is access. Okay, so very quickly, talking about the tax residency rules for individuals. We have four types of residency that applies to individuals in Canada, starting with the first one, which is a person who is considered to be a resident of Canada, generally will have significant residential ties. And significant residential ties include having a home available to them or to him, having a spouse in Canada and dependents in Canada. If you have a home, spouse, and dependents in Canada, then those are considered to be primary ties or significant ties. And then and these individuals, if they're resident of Canada, are taxed on worldwide income in Canada. A deemed resident is a person who was present in Canada for more than 183 days. Generally, it's relevant for non-Canadians traveling to Canada and happen to spend 183 days. The term is used in the tax treaties as well. But for these individuals who are considered to be deemed resident, they're generally taxed on Canadian source income only. Some exceptions apply. And if you're non-resident, so you no significant residential ties and you spend less than 183 days in Canada, again, you're taxed on Canadian source income only unless the treaty applies and the treaty benefits the states that the person does not have to pay tax in Canada. But the domestic law, whether you're deemed resident or non-resident, you have to pay tax um, on Canadian source income only unless the tax treaty applies. And then part-year residents are those individuals that enter into Canada or immigrant or new immigrants or a person who migrate to Canada, or if they are immigrant, means they'll leave Canada during the year. So those type of individuals are considered to be part-time residents. So they are taxed in Canada on their worldwide income up to the date they were considered resident of Canada. So say if someone, becomes a landed immigrant in Canada in July. So you say July 15th, and from July 15th to end of December 31st, they were part-time resident and should be taxed on worldwide income for that period. But any income earned prior to blending into Canada would be exempt from Canadian tax because they were not considered a resident at that time. Um, there are, in terms of residential ties, we have primary ties and secondary ties. The primary ties include having a home, a spouse in Canada, and dependents in Canada. If you have the three of them, then we don't even have to look at the secondary ties. Um, but other secondary ties that may be relevant to consider the residency of an individual includes personal property in Canada, such as having a car, furniture, and then social ties in Canada, having memberships in Canada with the local organization. Economic ties include having job in Canada, bank accounts, credit cards. Driving license is very important, and Canadian passport. Having a Canadian passport can be very important to determine the residential ties, and also health insurance with the Canadian province. Is considered to be a significant secondary residential tie. For corporations, it is generally more straightforward. So a resident corporation is the one that is either incorporated in Canada. So it can be a federal incorporation or provincially incorporated legal entity. But if you're incorporated in Canada, the corporation, then it's taxed on worldwide income in Canada. But it also includes managed and controlled from Canada. So it can be a foreign corporation that is managed and controlled from Canada. In that case is unless the treaty provides some sort of protection or tiebreaker rule, those corporations, if they're considered to be resident because of mine management in Canada, are taxed on their worldwide income in Canada. And a non-resident corporation is, of course, the one that is incorporated outside Canada, the end managed and mine and management outside Canada. They're only taxed on Canadian source income. Some exception applies, means unless the US-Canada treaty applies, then the threshold is increased to having a nexus or significant presence, which we refer to as permanent establishment in Canada. Otherwise, they're generally exempt. Last one is deemed resident corporation. Certain corporation, trust, partnership, and entities deemed to be resident under the tax treaties, then those are taxed on worldwide income in Canada. Here's a summary of the tax residency and sorry, the summary of tax rates across the major provinces. So you can see the federal rate is the 15 across all the provinces. And these are some of the major provinces, not the exhaustive list of all the provinces. But in BC, British Columbia, the provincial tax rate is 12%. This means the combined tax rate on income earned through a corporation is 27% in BC. Alberta is the lowest at 23%. And then Ontario, you can see 26.5% with 11.5% provincial rate plus 15% federal. So that's the Ontario. Quebec is approximately the same. I think the rate has reduced over the years, used to be higher in Quebec. And then the other thing that most corporations have to consider is the repatriation and dividend withholding tax. So you have two layers of taxation. One is when the income is earned in Canada through a corporation. So that's what is subject to the combined corporate tax rate. And then when the income is repatriated outside Canada or dividend is paid to the foreign parent, let's say, or to the shareholders, then the domestic withholding tax rate is 25%, but under the tax treaty, the rate is reduced. Um, the rate is reduced, and that, just a second, and that is 5%. The rate is reduced to 5% if the foreign parent owns 10% of the ownership. In all the other cases, it's 15%. And if no treaty benefit applies, then the default rate is 25%. So most commonly, if you have a US parent company that owns a US C corp that owns a Canadian limited corporation, then uh, upon distribution of any dividends to the US parent, the dividends will be subject to 5% withholding tax rate because the parent company owns all the shares of the Canadian company. Okay, this is the taxation with respect to the type of income. So employment income, which includes your wages, salaries, bonuses, generally reported on T4, which is equivalent to W2. This income is fully taxable at the progressive tax rates. Okay, and the progressive tax rate starts from 20% at the base level. There's a basic exemption as well, but then the tax rate starts at 20%, and then the maximum rate will go up at 53%. Again, depending on the province, because the rates will vary by province at the top marginal rate. That's if you're talking about Ontario, then the base rate is 20% and the max is 53% tax on income in excess of $215,000. That's the in Canadian dollars. That's the amount that will be, and any amount in excess of that will be subject to the highest tax rate. Business self-employment income. So this would be income from self-employment business activities. Uh, the Such businesses are allowed to deduct expenses, and then the net income is then subject to the progressive tax rates. Interest income, such as bank interest, bonds, treasury, and so on. These are fully taxable as ordinary income. Dividend from Canadian corporations. So dividend income is unique because when we say dividend income, then it generally means dividends from a Canadian corporation, whereas dividend from foreign corporation are considered to be ordinary income. Dividends from a Canadian corporation are taxed preferentially in the hands of Canadian individuals if they are eligible dividends, or they are, first of all, the dividends are eligible for dividend tax credit, and there's a preferential tax rate applies to dividend income from a Canadian corporation. But dividend from a foreign corporation are treated like ordinary income and taxed accordingly. Capital gains, this is unique, unlike the US, where 100% of the capital gain is included in income. Capital gains on sale of property like real estate, investments, and so on, only 50% of the gain is included in income, and that 50% is then taxed at the progressive tax rate. Rental income, this is income from rental properties. Again, you're allowed to deduct expenses that are directly related to operating or managing the rental property. The net income is taxed at the progressive rates. And then finally, the foreign income. This can include US wages, investments, and so on. They're fully taxable like ordinary income. However, a foreign tax credit is available for any US taxes paid. Okay, well, for that matter, like any foreign taxes paid, a foreign tax credit is generally available to Canadian residents. Foreign income, there is a distinction for capital gains, means, unlike dividend, where a Canadian dividend has an eligible is eligible for dividend tax credit and has preferential tax rate. Capital gains, whether they are Canadian capital gains or foreign capital gains, the inclusion rate remains 50%. So only 50% of the total capital gain is included in the taxable income. Okay, with respect to capital gains and losses, we have the inclusion rate against a quick comparison, so you can see between the US tax and the Canadian tax. The inclusion rate is 50%, applies to both as a Canadian individual realizing capital gain from disposition of property in Canada or outside Canada. The inclusion rate remains the same at 50%, and we are allowed to claim foreign tax credit if the capital gain was recognized outside Canada. In the US, there's a concept of long-term, short-term capital gains, but there's no such distinction in Canada. All gains are taxed at 50%. Capital loss treatment, slight difference. Capital loss can only be offset against capital gains in Canada, and so capital losses cannot be deducted against the ordinary income. The carry back, carry forward remains same. Means you can carry back capital losses 3 years and carry forward indefinitely. So that's the same between the two jurisdictions. And then principal residence exemption in Canada, there's a full exemption if principal residence conditions are met. If the conditions are met, then 100% of the gain is exempt from tax in Canada. A quick comparison of the corporate income taxation. The federal rate is 21% in the US, whereas in Canada it's 15% plus the provincial rate. The ballpark rate in Canada, both combined, means federal plus provincial is about 25, 26%. Um, there is a concept of small business deduction for Canadian controlled private corporations. And if it's a Canadian controlled private corporation, the first $500,000 of income is subject to uh, much lower tax rate. So I'll call it say 12% combined, but that's only available to Canadian corporations that are owned by Canadian residents and earning less than $500,000. The moment those businesses will exceed the $500,000, they are in the same bracket as everyone else, which is the 25, 26% tax. But um, um, but otherwise, if you are making less than $500,000, it's a Canadian controlled private corporation, then the rate is almost half the regular rate. And then there's a relief, double taxation relief with respect to when the dividends are paid to the when dividends are paid to the shareholders. In Canada, it's called tax integration system. Um, but generally, I think the similar concept applies in the US as well. And then the filing requirement in the US, it's Form 1120 for corporations. Here in Canada, we call it T2 corporate income tax return. In terms of the legal entity and some similarities, starting with the US LLC, or LLC as the type of corporation, in the US allows a flow-through treatment and can be elected to be taxed as a corporation, whereas in Canada, a LLC is not recognized as a corporation. However, in the cross-border context, and when you apply the tax treaty, the treaty will allow the benefits, but only on a look-through basis. So, uh, again, it's not considered to be a resident of the U.S. from a Canadian income tax perspective, um, but uh, but on a look-through basis, and when you apply the treaty, the benefits are available. There are still some restrictions on that, but unlike U.S., there are some hybrid mismatch issues, the way it's taxed in the U.S. versus how it is taxed in Canada. Um, the US C corporation and S corporations, those are the same. The Canadian tax system and tax law, along with the treaty, we look at the same way. Although the S corp is a flow-through entity, but the Canadian rules do not distinguish between a C corp and an S corp. Just for the fact that S corp is still a flow-through entity. They're taxed as and recognized as a corporation in Canada from an income tax perspective. Partnership, these are flow through entities in the US, income reported on the individual returns or the member returns, whoever is the member owning the share, the interest in the partnership. It's the same concept here in Canada. Partnerships are treated like a flow through entities, income reported on T5013. Unlimited liability companies, I assume these are very rare in the US, but in Canada, these are common, but only in the cross-border context, because a ULC, although it's treated like a regular corporation in Canada, but from a US perspective, the US can, under the US rules, it can be a disregarded entity or treated as a disregarded entity, and then allows the same flow through and entity benefits to the US investors and so on. So it's quite popular in the US context, but not locally. Locally in Canada, you will not hear Canadian entrepreneurs using this ULC structure. It's as I said, also it's taxed like a regular corporation. So as a Canadian entrepreneur, it makes no difference whether you incorporate a regular corporation or an unlimited liability company, other than the fact that it has no liability protection. Um, but it's more popular on the cross-border context because it does allow a flow-through treatment because it can be treated as a disregarded entity in the US. And finally, the sole proprietor business. This is reported directly on the individual's return, which is very similar to the US. Um, Here are some basic structures of how a US entity can expand and operate in Canada. So US company can set up a Canadian subsidiary, legal entity. It will be a separate legal entity incorporated under Canadian federal law or under the provincial law. It's treated as a resident corporation in Canada, taxable on worldwide income as a Canadian subsidiary, and provides limited liability protection for the US parent, which is a very good thing. And then it's most common and straightforward structure for US companies expanding into Canada, especially if the US company has long-term plans to expand, operate in Canada, hire Canadian employees, sign a lease in Canada, or certain type of government contracts if they are going for those contracts and whatnot. Then you having a Canadian subsidiary is the most popular and common approach among U.S. companies expanding into Canada. Now at ITAX CPA, we can help and determine the best structure for doing business in Canada. Uh, of course, depends on the structure in the US. If it's a flow through tax deferred versus tax deferred structure, if it's a C corp, LLC, S corp, and then on the Canadian side, what is the most optimal solution? Can be a Canadian subsidiary, branch, or just operating, carrying on business in Canada. So we can maximize the treaty benefits and minimize the tax and withholding tax for operations in Canada for US companies. The other structure, which is also quite popular, is branch operation of a U.S. corporation. So in this case, there's no separate legal entity. The Canadian operations are part of the U.S. company, or the Canadian operations is an extension of the U.S. Company. Any profits of the U.S. corporation in this case will be taxed based on the source of the income. So to the extent the profits are attributable to Canada, only those profits will be taxed in Canada. It does not mean like operating in Canada via branch does not mean that worldwide income of the US company is now subject to tax in Canada. It's only the Canadian source income will now be subject to tax in Canada, and you're allowed to deduct all your expenses that are related to earning Canadian source income and so on. So it's just the net profit, or the tax will be applied on the net profit from the branch operations. There is an additional layer of tax because it's not a true subsidiary. There will be no dividends. Hence, there's a concept of branch tax, which is applied in addition to the corporate tax rate, which mimics the dividend withholding tax. Otherwise, everybody will just operate as a branch because you can save that 5% dividend withholding tax if you operate as a branch versus a subsidiary. So it just makes the level playing field for everyone, and you can choose to operate in Canada as a subsidiary or as a branch, but the tax generally remains the same. It may expose the US parent directly to the Canadian legal claims. Foreign tax credit is available in the US for income taxes paid in Canada. And so of course, one of the key benefit of the branch is the flow through treatment. Again, at ITAX CPA, we can determine the best structure for doing business and maximize the treaty benefits, minimize the income taxes and withholding taxes for you. And the last entity structure is using unlimited liability company. So This is a unique hybrid available in certain provinces, not across all Canada. So you can incorporate a ULC in Nova Scotia, Alberta, and British Columbia. These are recognized as corporations in Canada, and these corporations will be subject to tax on worldwide income. But from a US tax purpose, it can be treated as a disregarded entity or partnership, offering a much more potential planning benefits. Okay, and there are some issues on the or mismatch hybrid mismatch issues when we apply the tax treaty, but additional planning steps can be undertaken to fix the problem on that end. So it's not the end of the world, because additional planning steps can be taken to fix the issues to minimize the withholding tax problem. We also have partnerships and joint ventures, most common among the construction and real estate project. In this case, the tax is levied at the partner level based on the residency, and any withholding taxes are also applied on a look-through basis based on the residency. Again, it requires careful agreement drafting to avoid double taxation and missed deductions, and we can help you with all of that. Here's a quick comparison between the different types of legal entities structures. You can have a subsidiary branch, ULC, operate in Canada as a partnership, limited partnership, general partnership, or a joint venture. I'm not going to go through all of this in detail. We have briefly discussed already. This is something for you to take with you. And again, feel free to reach out to me if you have questions. Okay, now the question is, what triggers Canadian tax liability for a US person or a US corporation? So under the our domestic laws, again, and these comments that we'll be talking about are not taking into account the tax treaty. These comments are strictly, as the Income Tax Act or the legislation, without the presence of the tax treaty. So US person will be taxed on income in Canada if they're employed or they're working in Canada. This includes short business trips to Canada for client meetings or for other employment duties such as performing consulting, construction, installation work. So anytime the US mostly US employer will be sending US employees to work on jobs, on-site jobs in Canada, then the Canadian source wages for those individuals are subject to Canadian tax. Okay. And again, this includes the employer portion of the tax, means requirement to withhold tax, and then the obligation on the employee to file a return. A lot of that can be easily managed by filing proper waivers. We will discuss the waivers at the end of this course. But I just want to highlight here that yes, this is the trigger point, but we also have to take into account the tax treaty as to when the individual US person is subject to tax or not. So of course the treaty can minimize some of the compliance and taxability, and then secondly we have the option to submit waivers, ideally ahead of time, to protect the employee from any unnecessary withholdings in Canada. For US corporations, the trigger point is carrying on business in Canada. The term carrying on business is generally referred to as a US company entering into Canada for any profit-making activity that should be sufficient to trigger a tax liability in absence of the tax treaty, by the way. And one of the key criteria for carrying on business in Canada is on-site presence, means you need to demonstrate that the US company was doing business in Canada through an employee or agent or contractor and so on. So US company that's selling goods or services in Canada through an agent and employee would be considered carrying on business in Canada. Or employees of US company are soliciting, performing sales and marketing activities physically in Canada. Again, the sales and profit making activities being conducted while physically an employee was in Canada, that will trigger the carrying on business threshold, or meet the threshold for carrying on business. And US employees coming into Canada to attend client meetings, trade shows, conferences, this is also considered as carrying on business in Canada. Now, this will trigger the tax liability under the legislation. However, the tax treaty will, of course, override the base case scenarios and say, oh, no, as long as there's no PE, permanent establishment in Canada, the US companies are free, can enter into Canada, do business in Canada, and don't have to pay any tax. But that's the benefit of the tax treaty. A corporation coming from a country that has no treaty with Canada, say Bahamas, um, then these rules will be applicable to that corporation. Okay, and then we have a U.S. corporation or individual that's disposed of real property, including Canadian real property, land, a building, or shares of private company that derives value from Canadian real property. In that case, either whether it's a U.S. corporation or U.S. individual, they will be subject to Canadian tax. Now, these are generally referred to as capital gains, right? Right. If a US individual owns a Canadian rental property, happen to dispose of that property, then those capital gains will be taxed in Canada. Otherwise, in general, capital gains are sourced to the home country. Say if a US person owns shares of some of the local banks here in Canada, then the US person will not have to pay capital gain tax in Canada because the capital gain is sourced back to the home country, but the exception is made for real property or immovable property. And then finally, to the extent a non-resident or US individual or corporation is earning Canadian source passive income, including dividend, interest, rent, royalties, there will be a withholding tax applicable, and the rate is reduced under the treaty. By default, it's 25%, but the treaty can reduce it all the way to nil. It depends on the nature of income, can be reduced to 15%, 10%, 5%, or even zero in some cases. Okay, Sam, can you quickly run the first poll?
Sure, I can launch the first poll. All right, everyone, here's your first polling question. Please take a moment to submit your answer. You'll have 1 minute to respond. Thank you. Thank you, everyone, for your quick responses. Afan, you can continue.
Okay, I think it was a different file, the file with 5 questions. So not sure if you're using the correct polling questions.
Um,
There was a final quiz. I think this might be from the quiz, not from the polling one, but that's fine. Look at the other file.
okay, we will.
Okay. Now, there are a couple of case studies just to give you a quick overview of the Canadian taxes and also how it applies to a US company. So let's look at the fact, first of all. So this is relating to a US company selling goods to Canada and employees, frequently visiting to Canada. So in this case, the facts are US company that sells goods to various distributors and retailers in Canada, sales over $5 million. These are annual sales in Canada. The US employees frequently travel to meet with customers in Canada. However, there is no office, no permanent establishment or nexus in Canada, and there are no Canadian employees. So, based on the facts, and a lot of US companies, do business in Canada in the similar fashion where they are, selling goods from outside Canada. So, to distributors and retailers in Canada, and then they're also sending their employees very frequently to, either go on site and fix the maybe let's say repairs and maintenance type work, or meet with the new customers and solicitation marketing activities and so on, right? So in this case, the US company is considered to be doing business in Canada and will be under the tax net. But however, under the treaty, because there's no permanent establishment in Canada, there should be no final income taxes owing, but there are still, some compliance obligations. So let's go through the compliance obligation. First of all, the U.S. company is considered to be carrying on business. They are required to file a Canadian tax return and claim a permanent establishment exemption under the treaty. They're required to register for a Canadian tax ID number, register for GST HST sales tax, collect, depending on the province, 5%, 13% tax. Sales tax should be collected from customers they're selling to. And the fact that they're sending employees, these employees are also subject to payroll obligations unless we submit the waiver. So apply for the payroll waiver for US employees traveling to Canada on short business trips. And finally, filing the treaty exempt tax return and filing the sales tax return. This is the key. Right. So, how we can help at iTax CPA, we can register the US company for doing business in Canada. We can obtain the tax ID, business number registration. Again, this is all of this can be done in 1 to 2 days. Um, Registration for the GST HST takes some time, but again, we can help with registering for GST HST. We can file the annual treaty-based tax return, claim the refund of withholding tax. Now, to the extent the customer happened to withhold any taxes, we can claim the full refund of those withholding taxes, and we can also file the waiver for US employees coming into Canada. Let's look at the second scenario. This is a US company providing services 100% remote. So in this case, the US company provides IT solutions and services to customers in Canada, say $2 million in annual sales to Canadian customers. None of the US employees travel to Canada. There are no Canadian employees, means no Canadian resident local employees, nor US employees traveling to Canada on short visit. There's no office or permanent establishment in Canada. In this case, from a Canadian tax implications point of view, the US company is likely not considered to be carrying on business in Canada. There should be no particular Canadian tax implications other than GST HST. And GST HST rules are a bit more tricky than the income tax rules. So we have to review all the facts before we can decide or determine if if there's a requirement to register for GST HST. But there should be no income tax implications based on the facts here. And at iTax CPA, we can say if you are required to register for GST HST, we can register the US company, register the company for GST HST, and to the extent applicable, file treaty-based returns, file waivers, and claim the withholding tax refund if that so happens to be in this case. The last scenario, this is where US companies provides consulting services. So it's not selling goods into Canada, but now it's a US company providing consulting services to customers in Canada. This can be, say, legal engineering services uh, to customers in Canada. Their sales are about 500,000 annually. The US employee frequently travel to meet with customers or do the work on site. Again, there are no Canadian resident employees, no office PE in Canada. So the implications are very similar to the first scenario, where the US company is considered to be carrying on business. They're required to file an income tax return, although there's no tax to pay, but they have to file a return claim PE exemption, and they must register for a tax ID, register for GST HST, um, apply for payroll waiver, and we can do that, and then file the treaty exempt tax return at the end of the year because of the fact that they're doing business in Canada. And we can help with all sorts of Canadian tax compliance for US companies that are providing services or selling goods into Canada. Okay, this is just a comparison chart of how US companies can operate into Canada. They can operate through a branch PE, they can set up a subsidiary, or they can simply send employees, as we have seen in the previous examples. The US companies were simply sending their employees into Canada, and if you are doing so, you're exempt from income tax under the treaty. Again, quick comparison. Um, any questions, you can feel free to reach out to me. Unlocking the benefits under the US Canada tax treaty. Now, this is a very powerful um, slide because it summarizes uh, all the treaty benefits that are available to US entrepreneurs and US individuals or corporations that are earning Canadian source income. So in the first example, um, a non-resident would be subject to tax in Canada if they're earning employment income from working in Canada. Whereas if the US-Canada treaty applies, such employment salary is exempt from tax in Canada unless the US person exceeds 183 days in Canada. Okay, so that's the benefit of the US-Canada tax treaty. In case of businesses, businesses are generally taxed if they are considered to be carrying on business in Canada. However, in the case of US-Canada tax treaty, the business income is exempt unless the profits are attributable to a permanent establishment or nexus in Canada. So you can see the bar is raised under the treaty. For employment income, is raised from raised to 183 days. Um, and then for businesses, it's raised from not just simple business short business trips and whatnot, but unless there is a permanent establishment or nexus in Canada, the US corporation does not have to pay taxes on its income in Canada. Now there's filing and compliance obligation in all the cases, fine, but at least at the end of the day, a US company will not be paying any taxes in Canada other than some compliance to uh, to 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 basically say that they are exempt under the treaty, and in order to claim the treaty exemption, you have to file the paperwork with the CRA. Similarly, capital gains relating to sale of property in Canada, a non-resident would be subject to that. However, under the treaty, this there are a series of exemptions, and one of the key condition is that gains are only taxed in Canada for a US person if they're tied to real property, or if it's shares of private corporation, then again, as long as the private company shares drives their value from underlying real property, then those shares will be subject to withholding taxes. Otherwise, no. And then finally, for with respect to passive income, in absence of treaty, it's 25% withholding tax. But you can see if the treaty benefit applies under US Canada, the withholding tax rate on dividends reduced from 25% to 5% or 15%. On interest, it's 0%. And on royalties, it's reduced from, again, 25% to 0% or 10% in some cases. And we can help go through and navigate the tax treaty. We have the expertise to help you with that. Okay, here's a quick overview of the GST and HST. Um, Sam, can you run the the scenario question number 2 from polling question file?
Sure.
Okay, yeah, this one is correct. Okay, I think because we have only one participant, the correct answer was actually subsidiaries. Yeah, which business structure is most commonly chosen by US companies expanding into Canada? It's Canadian subsidiaries. The second option is most popular. Thank you very much. Okay. With respect to GST and HST, the GST is a 5% tax applied to most goods and services in Canada. Um, and GST is a federal level VAT or sales tax system. And then there's a harmonized sales tax, which is a combined tax between federal as well as the provincial. So not all the provinces are harmonized with the federal. The list of provinces includes Ontario, Nova Scotia, New Brunswick, PEI, and Newfoundland. These provinces have HST implemented. If you are buying, selling anything in Ontario, there's a 13% HST, and then some provinces there is no provincial tax. For example, Alberta, there's no provincial tax. Similarly, BC has a provincial tax, but um, it does not apply on everything. So if you're in BC, you are generally subject to 5% GST. Alberta is the same thing, subject to 5% GST. In Alberta, there's no PST whatsoever, but in BC there is a PST. Similarly, Manitoba has their own MST, Manitoba sales tax system and whatnot. We can help at iTax CPA. We can help you navigate through your sales tax compliance obligations and how it applies as you're selling goods and services. Okay. The other important concept with respect to GST HST is what about expenses? If you are incurring expenses in Canada, like paying rental expenses, travel expenses, meals, office expenses, and you're incurring the GST HST, then the question is, do you get the benefit of deducting those GST HST at the gross amount? And the answer is yes. So the way it works is if you're registered for GST HST, US, say US business, the US company, then yes, you will be collecting the 13% tax on all your sales to customers in Ontario. But with the same token, if you happen to incur expenses and pay GST HST, then you can deduct that GST HST from what you have already collected, and it's the net amount that you will remit to the CRA at the end of the year. Okay. Um, so again, basically it means it's not a cost to the business. The sales tax VAT in Canada, it's not a cost to the business. If you are registered and you are doing everything properly, then it's a pass-through cost to the end consumer only. However, ITCs or these input tax credit cannot be claimed for personal and non-business expenses. Okay. U.S. companies conducting business Canada may claim input tax credit on the GST HST they incur on expenses related to their Canadian operations. And also, if the U.S. companies are importing goods into Canada, they have to pay 5% GST at the border no matter what. So the good thing is if you are registered for GST HST, then this 5% is also 100% recoverable, from your final sales. Whatever tax you collect from your customers, you can deduct the 5% GST paid at the border, and hence you're not out of pocket. So a lot of companies, if they're not aware of these rules and they, for whatever reason, are not registering for the GST HST, if you are importing goods into Canada, then you are paying the 5% out of your pocket. So this 5% is eating your margins. right? So it's very important that you register right away and claim the full refund of the 5% cost at the GST paid at the border. Okay, here are the GST HST rates by province. Alberta, you can see it's 5%, BC 5%, Manitoba 5%. These provinces are not harmonized. Um, so the the BC has their own estate tax, which beyond the scope of this course. Same thing with Manitoba has their own state level VAT beyond the scope of this course. Uh, Nova Scotia, Ontario, PEI, these are harmonized provinces. So the tax rate in Nova Scotia is 15% on any sales made, and any sales made into Ontario is 13%, PEI is again 15%. Quebec, again, I would say Quebec has their own QST rate. So this 9.975 is the QST portion, 5% is the federal portion. So the total tax will be 14.975, but the filing will be different. 5% will be limited to CRA federal, whereas the 9.975, you have to file QST for that and remit to the Quebec tax authority. Okay, the question becomes who must register for GST HST? So any person that's carrying on business in Canada must register for GST HST. There are non-residents supplying digital. There are rules. There was recently new rules were announced is in light of the digital economy, that if you are supplying digital services or goods to Canadian consumers, then you have to register. Even though you don't have any physical presence, you may not have no employees in Canada, but if you fall into these digital services or goods, then you are required to register for GST HST respective. If you're selling through Amazon or Shopify, XC, if you're selling into Canada through digital portals, then you must register. Getting on business test primarily looks at place of contract negotiation, a place where the contracts are negotiated, place where goods and services are delivered, presence of Canadian agents, warehouse, or employees in Canada. And finally, uh, the base test is $30,000 of sales. If your sales are below 30,000, you don't have to register, or you can voluntarily register, but you're not required to. But if your sales exceed the $30,000, then you must register. But keep in mind that if you are supplying digital goods and services as a non-resident, then there's no exception whatsoever. You have to register. So you can see here's an example. So you can see the exception to the 30,000. Remote sellers of digital business must register for GST HST regardless of the threshold. An example can be US software company selling software subscriptions into Ontario must, may have to register even if no office in Canada, no employees, agents in Canada. Okay, here are some common scenarios that I thought would be helpful. Warehousing and distributions in Canada. An example is a US e-commerce retailer stores inventory in a Canadian warehouse via Amazon FBA or third-party logistics provider. The fact that they have inventory in Canada and they're selling the selling through the online portal to their customers in Canada, the CRA will consider the company to be carrying on business in Canada for GST HST purposes. And in this case, the company must register for GST HST. And not just that, the fact that you are importing goods into Canada and then storing at the third-party logistics site, you're already paying 5% at the border. And there's no exception to that. So it's very important in your interest, and it's best, it is in your interest to register for GST HST so that any cost you're incurring at the border, which includes the 5% GST, is fully recoverable, and you can get the refund of that, or at least net the tax paid at the border with whatever you have collected from your customers. Because as I've explained earlier, GST is not the cost to the business. So it's beneficial to register if you are on the say if it's a gray area whether you're carrying on business or not carrying business, or you should or may or not may register. The I would say you should register, and it will be in your interest and benefit. Okay, the second scenario is on-site installation or services. So US construction, engineering, or IT services company sends employees to Canada to install equipment, set up server, or perform consulting. Um, Even if work is temporary, a few weeks or months, providing services physically in Canada triggers GST HST registration. In this case, GST HST must be charged on service invoices to Canadian clients. Okay. Canadian sales office or agents. So if a US manufacturer opens a small sales office in Canada or uses independent agents who regularly solicit orders in Canada, CRA generally deems this as carrying on business because contracts are being negotiated and fulfilled in Canada, and the GST HST registration is required on Canadian sales. Digital goods and SaaS sold to Canadian customers. This is a easy example the where US company must register. So let's look at the scenario. The US software company sells SaaS subscription apps or streaming services to Canadian individuals. Okay, starting 2021, July 2021, new rules require mandatory GST HST registration for foreign digital suppliers, even with no Canadian presence. So you must register under the simplified regime and remit the tax quarterly. Other examples include trade show and temporary sales. So this is where US company sells good at a Canadian trade show or convention for equipment, art, clothing, whatever. And then even short-term or seasonal sales are taxable supplies made in Canada, and you're required to register for GST. Leasing equipment to Canadian businesses. Again, I've worked with a number of US companies that are leasing equipment to Canadian businesses. For use in Canada. And the same thing, since the equipment is used in Canada, CRA consider it as a taxable supply made in Canada, and GST HST registration remittance requirements are required on lease payments. Sam, can you run poll number 3? Question number 3.
Sure.
Okay. Do you want to guess the participants? Um, the correct answer is A, because it's a digital services that the US company is providing, you will fall under the new rules. And there's a mandatory requirement to register. So A is the correct answer in this case. Okay. I've a couple other scenarios. Again, same thing. So SaaS providers selling subscription to Canadian consumers. They says this will fall under the mandatory registration rules for a US company to register and remit the tax to the CRA. Again, there's no real cost to the business. All you're doing is collecting the tax from the end customer and passing it on to the government. And if you happen to incur any GST, HST, you're allowed to deduct that if you register properly. Digital streaming services, same rules apply. E-commerce retailer using Canadian fulfillment warehouses, in same rules apply. US online sellers or US online seller uses Amazon FBA to store inventory in Canadian fulfillment center and sells to Canadian customers. And the fact that you have inventory in Canada, you're carrying, it's almost like carrying on business in Canada, and hence you should be registering for the GST HST. Marketplace facilitator rules, same thing. A US artisan sells digital art prints through Etsy to Canadian buyers. Again, you must register in this case for GST HST. Okay, so those were the common scenarios. Now we're going to quickly talk about the withholding taxes. Anytime US company provides services in Canada, so on-site consulting services, construction services, installation services. But if the services are provided on ground in Canada, the payer has an obligation to withhold 15% and remit on your behalf to the government. Now, this 15% is fully refundable to the US company if you file a treaty exempt tax return, but basically it's only refundable if you can prove to the government that under the treaty you're exempt, you did not have a permanent establishment or nexus in Canada, and that you're fully compliant with all the tax um, rules. Then the full 15% amount withheld at gross will be refundable to you. This 15% is not a final tax. The non-resident must file a Canadian return to determine the actual liability. In this case, the treaty will provide the exemption, but you have to file a treaty-based return to claim that exemption. Now, there is a waiver place, so if you are can be proactive, then we can submit the waiver ahead of time to the CRA, and you know, uh, again, submitting the waiver does not eliminate the requirement to file the end tax return, but at least it will protect you from the cash flow, because in some cases 15% of the gross amount, that's a significant amount and can cause cash flow problems. So filing the waiver application will smooth out the cash flow problems. And then there's also the withholding tax with respect to sending remote or sending employees to Canada. This is the employee level withholding tax. Same rules apply if we submit the waiver ahead of time and the employees are here on a temporary basis, not exceeding 183 days, then the taxes can be eliminated if the waiver process is completed and submitted properly, and we can take care of all of that for US companies easily. Okay, so we have about 10 minutes. This is for Q&A session I've left. There are a couple of um, poll questions. So number 4, can you run poll question number 4,
Sure.
Sam? Okay, question number 4. Which statement best describe Regulation 105 withholding on payments to US service providers in Canada? So you can attempt this answer, attempt the question. Yep, number C is perfect. Thank you very much. We'll end the poll, share the results, and we can move to poll number 5, Sam. You can answer this question, poll question number 5. The correct answer was B. In the US, you don't have federal level of VAT. I believe it's a state level only. So B is the correct answer. Okay, I did see there were some questions when I was going through. So let's take a look at if there are any questions. Okay. Are there any questions among the participants?
Uh, no, Afan, there are no questions. But if you can give a quick recap or something for 7 to 8 minutes, as we haven't hit the mark yet for 80 minutes. So
Mm, okay.
thanks.
I was planning for 10 minutes of Q&A. That's fine. So, with respect to Reg 105, this is an important topic as it applies to non-residents. It applies to non-residents coming into Canada. Uh, Generally, it applies to US contractor, consultants, engineers, technicians, or service providers. Um, the best way to address the Reg 105 is the sooner you can reach out to one of our team members, we can help you submit the waiver, and that will minimize your withholding taxes. But besides that, there are still a few important notes. For Reg 105, the withholding tax only applies on the withholding tax only applies on the work done performed in Canada. Now, to the extent there's work performed outside Canada, um, you can ask the payer to exclude the withholding tax on the portion of work that was performed outside Canada. Um, and again, that will minimize the cash flow for you, because oftentimes you're sending employees to Canada, and there's some work that can be performed remotely. And you don't want the withholding tax to be applied on the full proceeds or full gross amount of the invoice. So that is one good strategy to minimize the cash flow impact. And then submitting the waiver, so again we can help you with the waiver process. In most cases, when we are submitting the waiver process, there is an obligation or requirement that you register for the CRA tax ID. So if you already have that, good. If you don't have the if you don't have the tax ID, then we can submit the business number application, obtain the tax ID. Um, if Reg 105 is applicable, chances are GST HST is also applicable. So we can register you for the GST HST as well. And when submitting the waiver application, there's generally a requirement to provide the contract. So copy of contract becomes important, because what will happen is when we submit the waiver application to the CRA, one of the waiver officer will review the whole application, and they will in most cases he will call us as the authorized representative to they'll cross question, ask for the questions, because the condition to grant the waiver is to make sure that you will not have a permanent establishment in Canada. And that's the important test, to make sure that you will not have a permanent establishment in Canada, the employees will not exceed the the 183 days in Canada. And to the extent you're using other US contractors doing performing work in Canada, then the waiver officer will make sure that you are on site, means on site, and you understand your compliance obligation, so we can take care of all of that for you. um, with respect to the additional details on Reg 102, the there is few types of Reg 102 waivers. One is called RC 473, which we can submit the waiver. It's a blanket waiver, which means you can send as many US employees as you want to Canada. One of the key conditions is that those employees should not be exceeding more than 45 days. There is a 45 working day test and a 90-day presence test, but we can take care of all of that for you, and ask the right questions to make sure the employees are eligible. But generally, if the company was sending temporary employees to Canada, employees in most cases don't exceed the 45-day mark, and that blanket waiver is always available. But if so happens that the RC 473 blanket waiver is not sufficient, then we still have other options to submit um, a regular regulation 105 102 waiver. And in that case, yes, you will be allowed to stay in Canada for more than 45 days, 90 days test, as long as you will not exceed the 183-day mark. We can apply for the waiver and get the protection, because if you have not submitted the Reg 102 waiver, or you don't have the payroll waiver, the compliance becomes very, very tricky. Means the employer will have to withhold the tax first of all. Although the treaty may provide an exemption, but that exemption is only available at the employee level, not the exemption is not available to the employer, but to the employee, which means the employer has to withhold, file the taxes, means, file the W-2 equivalent, which is T4, and then the employee will have to file their T1 personal tax return, claim the refund of the withholding taxes. And so again, you can see there's a huge series of compliance issues. All of this can be reduced and saved if there is, if we address the problem ahead of time and submit the blanket waiver before. Okay, besides that, let's see. So we have discussed the GST HST in depth. I assume there should be no questions on GST HST. And again, unlocking the treaty benefits. If there are questions, let me know. We can quickly go through this chart, and that should take another 5 to 6 minutes. So tax implications in Canada, you can operate in Canada via these three models. You can just send your employees into Canada for client meeting, solicitation, attend, conferences and whatnot. Under the US Canada tax treaty, as long as there is no permanent establishment, no PE, no nexus in Canada, the profits are exempt from tax. However, there's still an obligation to file the tax return, yes, but there's no final tax liability because you're exempt under the treaty. The fact that you are providing services in Canada or consulting services, the payer, your customer might withhold 15%, but full refund of this 15% should be available when we file your tax return. Now, this type of operating model does not provide legal liability protection, which is why using a Canadian corporation might be important. So it depends on the business type. Like if you are providing legal services in Canada, it might be better off using a Canadian corporation, or it can be legal services, construction services. But if it is, say, IT services, so generally there's not a huge legal liability problem. So it also depends on the business whether you really need the legal protection. But if no legal protection is needed, then you can simply operate in Canada without nexus. In this case, you are still required to register for Canadian tax ID. You're required to register for GST, HST. And one of the downside is that CRA can access the books and records of the US company, of operating in Canada in under this method. The next is the branch, or having a permanent establishment in Canada. So in this case, again, you have tax filing obligation and requirement. There's final taxes owing. In addition to the income tax, which is your federal provincial tax, there's its a branch tax is added of 5% if treaty benefits are available, and 15% withholding tax still applies. So the fact that you still are a non-Canadian or non-resident company providing services in Canada, the payer is now obligated to withhold 15%, but that 15% withheld will be used as an installment towards your final tax liability, and any amount that is withheld in excess of the actual liability is fully refundable. The branch does not offer legal liability protection. You have to register for Canadian tax IDs, sales tax, GST, HST, and CRA can access your books and records in the case of an audit. And the final one is the US company using a Canadian subsidiary. This is by far the most common structure. Yes, there is tax filing obligation, but only the CanCo. So CanCo will file the tax returns. The US company has no obligation unless the US company is still sending their employees and doing some work. Otherwise, the US company has no obligation here. The Canadian company will be filing the tax return. Uh, Again, Canadian company will be subject to tax on worldwide income, and there's final taxes owing. There's no withholding taxes. So this is one of the another big benefit of operating in Canada through a Canadian subsidiary is because now the payer has no obligation to withhold 15%. Unlike providing services in Canada as a non-resident, now you are not providing services as a non-resident. Instead, you have a Canadian entity that is providing services on behalf of the US parent company. Um, so there's no 15% withholding tax. There's legal liability protection. There's no need for the US company to register for any Canadian business number. The Canadian company itself is already registered, and Canadian company will register for the GST and HST. And the CRA access, if there is an audit or something, these the CRA can only access the books and records of the CanCo. The CRA should not have access or right to access the books and records of the US company. Okay, Sam, let me know if this is good enough.
Yes, Avan, thank you so much. It's pretty good.
Okay. Now, can you share the training video with me after it's all done? You have my email address, right?
Sorry, what do
Like,
you
can
want?
you share the video
Uh, yeah,
recording with me? Okay.
sure, sure. So it takes around an hour to
I understand.
process it.
Yeah,
Yeah,
I understand. No, that's fine. Okay,
the
I think
team
that's good.
to
Do you have
share the
any?
recording with you. Okay.
Okay,
Yeah,
thank you very much.
no worries.
Bye bye.
Uh, and that wraps up today's session. Thank you all for being such a wonderful audience in today's MyCP1 webinar. We hope
Thank
you
you.
found this session both informative and valuable. A special thank you to our presenter Afan for sharing his knowledge and expertise with us today. Let's give him another round of applause in the chat. To obtain your CPE certificate, please remember that you need to have answered all the polling questions. You will also receive an evaluation form within the next 24 hours and will love for you to share your feedback with us. If you'd like to provide a video testimonial about your experience, you can do so in the evaluation form. We appreciate hearing your thoughts. If you have any follow up questions or would like to access the recording, please don't hesitate to reach out to us at support@my-cpe.com. Once again, thank you for joining us and we hope to see you at our future webinars. Have a fantastic day ahead. Thank you so much, Afan. You have a wonderful day.
Thank you.